Hello to all investors, welcome to another digestible investing video. Good to see you. In today's video we'll do a quick summary of the Essays of Warren Buffett, 4th edition, by Warren Buffett, compiler by Lawrence A. Cunningham. A friendly reminder to buy the book, and support the author for the full complete content if you like what you see. Our quick summary might do injustice to the authors, and their complete value. With all due respect and no further delay, let us dive in. Did you know allocating of cash depends on 4 fundamental concepts, instead of relying on rumors? 1. The probability of the event occurring. One great example is George Soros's big bet is to believe that this bet made him a whopping $1 billion in a single day. He did his homework and he bet against the British pound. During this period Britain joined the European exchange rate mechanism, also known as EMR, so Britain has to keep its currencies within range of the German mark. Mr. Soros recognized that the pound was overvalued, and it can't sustain keeping the pound afloat for long, so he short the British pound. Around late 1992 this bet paid off for Mr. Soros. 2. Time the fund will be tied up. 3. The opportunity cost. 4. The downside if the event doesn't occur. As an investor, it is wise for us to evaluate all these facts before we put our capital at work. Have you ever wanted to buy a business? If yes, what are the few things we should know before we buy the business? As a friendly reminder, many great investors always mentioned that when buying a stock is the same thing as buying a business. Therefore, when buying a business we have to consider the following things to analyze. 1. What sort of economic value attached to this business? For example, what is this business selling? And is the product or service offered by this business is what the customers want? Just imagine a business that sells ice up in Alaska somewhere. Not all business trading on the stock market will make sense. 2. What is the competition like? Taking from the last example, the business that sells ice. The competitions are everywhere in Alaska. Even Mother Nature wants her fair share in the ice market. 3. What can the return on equity likely be over time? 4. Is this the guy to run it? 5. Is he going to be straight with me? If it is a good business it is predictable. If not, forget it and move on. Here is a quote from Mr. Munger is worth mentioning in this section. You're looking for a mispriced gamble. That's what investing is. And you have to know enough to know whether the gamble is mispriced. That's value investing. Avoid business that is drowning in cash. Don't do it. Cash is like oxygen to a human and only thinks about it in its absence. Borrowing from Mr. Munger again on a cash-draining company. An example of a cash-draining company taking from Mr. Munger in this book is like a construction company equipment. You work hard all year, and there is your profit sitting in the yard. We avoid business like that. We prefer those that can write us a check at the end of the year. Another good example of a cash-draining industry is the automobile industry. A lot of cash, or profit, must be reinvested back into the business not only for research and development, also known as R&D, but to keep their factories up to date as well. It is also worth noting that good companies have the following approach to distribute their profits after all the expenses of keeping the company afloat. 1. Is to buy back their own share when it is right to do so. The worst share buyback is the following reasons. Buying back stock is in fashion. Over-optimism of their company value and to offset share, so their stock price can go up, and then executives use this opportunity to exercise their stock option. 2. The second thing that a good company does with its profit is to give a dividend to its owners. 3. Use the profit for growth.
Before we move on to the margin of safety and intrinsic values, please, if you like what you are seeing so far, may you kindly with all your might click the likes and subscribe button below, we really appreciate it. And once again thank you so much for your like and subscription in advance.
The margin of safety and intrinsic value. According to this book, the margin of safety is the principle of success and the cornerstone of investment. When buying below the margin of safety, use the intrinsic value of the stock, but 30% below of the intrinsic value to have a good safety margin just in case. And, with respect to intrinsic value, it should grow by at least 10 to 15% a year to be an attractive investment. When calculating intrinsic value, it is not a precise figure, but an estimate. It is an estimate that must be changed if the interest rate move or the future cash flow of the business are revised. The intrinsic value should reflect these four components. 1. Reflect the interest rate. Please note, at a low rate, we should use the average rate through a long period of time, and is always wise to be as conservative as we can. 2. Book value is the cornerstone. 3. Discounted rate. 4. Cash flow that the business generates. After all of these considerations and number calculation, but keep in mind, if the business is going to change in 5 years, we are just playing with the number game. So please make sure the business doesn't change in 5 years. When using a margin of safety and intrinsic value in our investment, we shouldn't just play a number game. Make sure the company will be there for more than 5 years, as mentioned above. Avoid buying a stock that is trading near their intrinsic value. Use the margin of safety to evaluate this. If anyone is interested in getting access to free intrinsic value calculators, please visit our website at valuesnip.com. When you join our site, please email support@valuesnip.com and tell them that you are our subscribers on YouTube, and they will provide you with more credits and more free calculators. Thank you all. Description will be below. We are going to touch a little on the spin-off company and their danger. Be careful with spun-off companies. They often claim that they are free from the bureaucracy of the parent company, but that is usually at the expense of the owners. And, for earnings, always look through the lens of earnings and power of earnings instead of prices. When looking at earnings, we should scrutinize the act of the retained earnings used after it is earned. Fraudulent companies can play all types of creativity with numbers, but it is very hard for them to lie about what they spent on and where the money is used. We should look into that. For example, in this book the author mentioned that we shouldn't care if the auditor cuts the falling tree in the forest. We should watch who the tree belongs to and who keeps it afterward. Outrageous executive bonuses and expenditures at the expense of the shareholders should be alarming. That the management is leeching from the company instead of serving it. We only want the management that serves the company. Having executives and management that serve themselves is like keeping a bunch of bees in your pocket as a pet. Remember, wear some protection before you put your hand in your pocket to get some honey out.
Before we let you go, please, if you do well or when you do well in life, seek ways to pay it forward to others that are less fortunate than you. This message was brought to you by payingforward.net. Direct giving is what they believe in. Thank you so much for your time and your attention. We hope to see you in the next